What if I told you the money you use every day is just a government's promise, with no real value backing it? It's called fiat currency, and understanding it is key to knowing how our economy really works. Before we go any further, let's break down the 3 basic reasons why we use money in the first place. First, it's a medium of exchange, which means people accept it when buying or selling things. So we don't have to trade items like in the old days. An example of this is the barter system. Let's say Robert has 10 apples and George has 1 loaf of bread. Robert needs bread and George needs apples, so instead of using money, they agree to trade. Second, it's a store of value, which means you can save it now and use it later, and it will still be worth something. Third, it's a unit of account, which helps us measure and compare prices, like knowing a phone costs $800 and a burger costs $8. These 3 simple roles are what make money so powerful in everyday life. Now that we understand the basic roles of money, let's take a quick look back in history to see how money used to work before fiat currency took over. For a long time, most countries used something called the gold standard. This was a system where the value of money was directly tied to a specific amount of gold. This meant that for every dollar or pound or whatever currency printed, the government promised it could be exchanged for a specific amount of gold. Because gold is rare and valuable, this system gave people confidence that their money wasn't just paper, it was backed by something real and precious. It helped keep inflation low since governments couldn't just print an unlimited supply of money without having enough gold to back it up. However, the gold standard had its limits. Because the money supply was restricted by the amount of gold reserves, governments had less flexibility to respond to economic problems like recessions or wars. They couldn't just print more money when the economy needed it, unless they had more gold to back it up. Over time, these restrictions made the system less practical, and eventually, countries, including the US, moved away from the gold standard, switching to the fiat money system we use today. So what exactly is fiat money? Fiat currency is money that has no intrinsic value. It's not backed by gold, silver, or anything physical. Its value comes entirely from government trust and public confidence. In other words, a $20 bill doesn't have $20 worth of paper in it. It's just a piece of paper, or numbers on a screen, that we all agree has value because the government says so, and we trust that we can use it to buy goods and pay taxes. This system gives governments and central banks a lot more control and flexibility over the economy. They can adjust interest rates, print more money, or stimulate the economy when needed, without being limited by gold reserves. But that flexibility comes with risks, because there's nothing physical backing the money. Governments could overprint it, and when that happens, you get inflation. In extreme cases, it can lead to hyperinflation, where money becomes almost worthless. A real-world example of this is Zimbabwe. In the 2000s, Zimbabwe's government started printing massive amounts of money to deal with economic problems. But without anything backing it, and with a shrinking economy, the value of their currency collapsed. Here's why. When a country prints too much money without increasing the amount of goods and services available, prices start to rise fast. Think of it like this. Imagine there are 10 loaves of bread in a market, and $100 total in circulation. Each loaf might cost $10. Now imagine the government prints 1,000 more, but there are still only 10 loaves. Suddenly, there's $1,100 chasing just 10 loaves, so prices shoot up. That same loaf of bread now costs $110 instead of $10. That's inflation. But in Zimbabwe, it didn't stop there. The government kept printing money, even as the economy shrank. Fewer goods, more money. This led to hyperinflation, where prices weren't just going up, they were doubling every day. The inflation rate was so out of control, the government printed a $100 trillion bill. Eventually, the Zimbabwean dollar became so worthless that the country had to abandon its currency and switch to using foreign money just to survive. That's why central banks, like the US Federal Reserve or the European Central Bank, play a crucial role. They manage how much money is in the system, aiming to balance growth, employment, and inflation. So while fiat money gives us a more adaptable and modern economic system, it all depends on one thing: trust. Trust in the government, trust in the system, and trust that the money in your pocket will still be worth something tomorrow. So what's next for fiat money? Fiat currency has powered the global economy for decades, but today it's facing new challenges. For one, trust is everything. And when people lose trust, whether because of inflation, political instability, or excessive money printing, the value of fiat currency can quickly erode. We're also seeing a rise in digital alternatives. Cryptocurrencies like Bitcoin were created in response to concerns about government control and inflation. Unlike fiat money, many of these digital currencies have a fixed supply and aren't controlled by central banks. While the world of money continues to evolve, countries around the world are exploring central bank digital currencies, CBDCs, basically digital versions of fiat money. So while fiat money isn't disappearing anytime soon, it's definitely evolving. The future might not be about paper bills or coins, but about digital trust. In the end, money, whether it's gold, paper, or digital, it's only as strong as the trust we place in it. Thank you for sticking to the end and watching the video. We hope you enjoyed. Please like, comment, and subscribe for more videos.